This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our previous lecture on property income, we saw the main aspect of a property income assessment. That was determining the rental income accrued, from which we then deducted any allowable expenses incurred. Those allowable expenses, of course, being revenue and not capital expenditure in nature. We also looked at some of the more peculiar circumstances that one might find oneself in as a taxpayer, where, for example, rather than separately letting out an independent and, as we said, separate property, you actually let out rooms within your own property, within your own main residence. What that brought in was the rent-a-room relief. We also saw the very specific area of furnished holiday lettings, where we had to keep a separate record of any such income and expenses and any overall profit or loss. Why did we do that? Because there was some preferential treatment so far as that particular type of letting was concerned, most of which we couldn't actually get to grips with at this point because it's mostly to do with capital gains, if you recall, and the very generous reliefs that that type of property would attract. But more of that when we look at our CGT chapters later in this course. But now in this lecture we finish off, to begin with, dealing with the property income assessments by looking at the second and final part of this property income assessment issue. A strange concept maybe to some of you, the idea of when we let a property out that the lessor, the landlord, may receive a one-off payment, a premium there, a lease premium, on the granting of a short lease. And we classify a short lease, as we'll see here on the note in front of you, as one of being of no more than 50 years. It will no doubt be significantly less than that in terms of the example you may see in an examination question. Now, what's the issue here? A part of this one-off receipt, it is a one-off, it does not recur each year of the lease, as does our rental income. A part of this one-off premium is to be treated as income. Another part of it, the other part of it, is to be treated as a capital receipt that would then go into a capital gains calculation. But fortunately for us, as we'll see noted here, the treatment of that capital receipt is outside our syllabus. So we don't have to worry about that. Not now at F6, nor indeed even at P6 there, should you go on to look at advanced taxation. So all we have to do is to be able to determine, and it's a pure calculation that we do, what is the income element of the premium received, and that, along with the rental income accrued within the tax year, will form the basis of our property income assessment for our taxpayer. Plus, the skills that we learn here are skills that will also repeat themselves in terms of a corporate tax problem, where it may be the company that is a lessor granting such a lease, and the same exercise may be repeated there. So what have we got? When a tenant, we're told here, takes on a new lease, he may be required to pay this one-off premium, in addition there to the annual rent. Now, why might this be payable? It may be that the landlord has carried out certain changes to the property to accommodate that particular tenant, and therefore is compensated for that by a one-off premium. It may be the fact that these particular properties are in a very desirable site, and they can therefore not simply command a large rent, but also command a one-off premium at the start of the lease period as well from any prospective tenant. We don't have to explain it anyway. All we've got to do is to calculate what is the income assessment. So, if the lease, as it will be, is for no more than, here less than 50 years, I said it will be considerably less than that, no doubt, in the question, but part of that premium assessed on the landlord is treated as property income there. Now, what is that calculation? Well, here we go. This is what we need to learn. We take the total premium, that is the P in this calculation, and multiply out by 51 years. Remember, a short lease is one of 50 years or less. So we go 51 minus n, n being the number of years of the lease here, over 50. Over 50. Basically what that means is if you granted a 1-year lease, then this calculation would read 51 minus 1 over 50 times the premium. Now that would be all of the premium. The entirety of the premium would be treated as income if we were granting a 1-year lease, because that's exactly what it is. It is income there. Whereas on the other hand, if we were to grant a 51-year lease, then you'd now have 51 minus 51, so 0. None of that premium would be treated as income. The entirety of it would be treated as capital, and that bit, remember, we don't have to worry about. So it's only the income element there. What you've basically got is a sliding scale between 1 and 51 years. So basically moving on a 2% basis a year between 100% of the premium being treated as income if it's a 1-year lease to 0% of that premium being treated as income if it was a 51-year lease. Now again, there's lots of different ways of learning how to compute the assessable premium. I'd recommend that you use this one. Again, it goes straight to the calculation of what you want, the assessable property income. So again, maybe not something to commit to memory at this point. It's the sort of thing that, again, closer to exam date, we'll need to be able to memorize. But of course, what you do need to be able to do now is to know how and learn how to apply. Well, we've got an example here coming up in example 4 that will allow us to do just that. Now remember, if we've got a calculation as required here of the property income assessment, then that's going to combine now the two components. The rental income working on our accruals basis, less any allowable expenses incurred, using the techniques that we looked at and hopefully we learnt in the first part of this chapter, in our previous session together indeed. And we also now got the premium element. Okay, so what have we got here? Bill grants Richard a lease to a shop on the 30th of June 15. So Bill is the lessor, Richard is the lessee. And the annual rent of this will be £15,000, and that's due on the 1st of July 15. So basically from the start of that agreement, and it's due on an annual basis. Well, that's easy enough to deal with in relation to your rental income. You know that on rental income, we work on an accruals basis. So the rental income accrued in here, the 15-16 tax year, well, it starts on the 1st of July 15, so that means to the nearest month, we've got 9 months of our annual figure of rent of 5,000 accrued in our 15-16 tax year. That 9/12 of 5,000 will, I think, be 3/4 of that is £3,750. If, of course, again, we were to get a bigger and better version of this in an exam question, then we may have to apply the techniques of our first lecture on Chapter 3 to establish the allowable expenses and therefore work out the net rental income assessment. But to that now, we need to add the assessable part of the premium. Right. I would like you, therefore, now to work out, using the calculation above, what that assessable part of the premium would be, and to actually show that as a calculation. So do pause this for a moment, please, before then you do the exercise, and then pick this up again, and we'll go through it together. Okay, so the basis of calculating the assessable part of the premium in terms of the income element. So how much is our premium received? £60,000. So we pick up that total premium of 60,000 and multiply out by. Well, two parts of this are consistent. It's 51 minus the number of years of the lease over 50. So the only variable is the number of years of the lease. And that here is 20 years. So calculators out, 51 minus 20 over 50 times £60,000. Now if you put that through your calculator, hopefully, again the same as I got, and that was, what's that now, £37,200 all being well. Now that's a one-off assessment only in this year, the year in which the lease is granted and the premium then is received. It would mean for this year we're going to have £40,950 as the assessable property income assessment there. Going forward, of course, our annual rental income accrued will be £5,000 until such time as the rent is reviewed, no doubt, within that 20-year lease period, less any allowable expenses incurred. Okay, should not therefore, I hope now, be a problem in working out for the lessor what his property income assessment will be. And basically the same techniques will be used when we turn our attention to corporate tax. But in our next chapter together, what we'll be doing in chapter 4 is to look at how, when dealing with a trader, we take what is an accounting profit, so a net profit at the bottom of our statement of profit or loss. We take an accounting profit and make it acceptable for taxation purposes. And what you may be dealing with there is maybe a business that has paid a premium as well as paying rent in relation to a given lease. So what we've got to look at now, here, this particular point in time seems a sensible point to do it, is in this example we've dealt with Bill, the lessor. But let's now turn our attention to Richard, the lessee, and work out what allowable trading profit deduction would be available to Richard in terms of the payments that Richard has made in relation to this period. So, looking now at the trading profit deduction for traders here in section 5.2. Now this is where we're looking at the lessee being a trader, using that property within their trade. Now what we should automatically understand is that any rent that is payable for the period is going to be an allowable trading profit deduction. So in chapter 4, as we said, we will be greeted by an accounting period. Remember that a taxpayer, an unincorporated, a sole trader or partnership business can prepare his or their accounts, his, her or their accounts indeed, to any date they choose. And for that accounting period, any rental payable for a property used within that trade is of course a perfectly allowable expense, and no adjustment will be required to that figure. What has been debited in the accounts will also be allowable for taxation purposes as well. But then we've got to look at the premium payment and work out in relation to that premium payment made by the lessee, here by Richard, what allowable deduction will be available to them. Now then, the way that it works is this. Where a trader has paid a premium, such as Richard here, for again what is a short lease, he may be able to deduct the following annual amount. So what's going to happen here is, rather than a one-off deduction in relation to the premium paid, in the way that there was a one-off assessment for the premium received by the lessor, for the lessee, we work out what is an annual trading profit deduction. So an annual amount, I repeat there, to set off against the individual, the trader's trading profit in each of the years of the lease in which that property is used within the trade. And that will be an extra allowable annual deduction on top of any rent paid, or indeed payable as it would be within the accounting system. So how do we work out this annual figure? Well, if you can deal with the lessor, it's very easy now to deal with the lessee, because we've got this calculation which brings in on the top line the only figure that you need to calculate, and that is the property income assessment on the landlord, on the lessor. So if you're dealing with the lessee, you've actually still got to do the same calculation as we've just done for the lessor, working out what is the property income assessment on the landlord. But rather than allowing all of that as a one-off deduction in this tax year to the lessee, no. Unfortunately for the lessee, what we have to then do is to spread it over the number of years of the lease, the life of the lease here, and work what is an annual trading profit deduction. So what we need to do here, using example 4 as the above, show the relief available to Richard for the premium paid. And what we'll be doing here is to work out an annual trading profit deduction. So, how did we work out the property income assessment to bill the landlord? We took the premium received of 60,000 and multiplied out by 51 minus the number of years of the lease, that was 20. So there we go. In this calculation, the life of the lease is 20 years. So we took for bill the lessor, the landlord, 51 minus 20 over 50 times 60,000. And that, you will recall, gave us a figure of £37,200. £37,200. We now divide that out by the 20 years, which means that Richard, the lessee, will be entitled to an annual deduction for each full accounting period in which that leasehold property has been used within their trade. Divide it out, and I think that comes to £1,860 per annum there. So on top of the rent that is payable each year of £5,000, they would also be entitled to that further, Richard would be entitled to that further trading profit deduction against the profits of the business of £1,860. So in our next chapter together, we will see that issue coming up again, working out for the trader what the trading profit deduction will be. Okay, we should now be able to deal, so far as the lessor, the landlord, is concerned, with a full property income assessment. One that deals with the rental income accrued, less any allowable revenue expenses incurred within the tax year. And what we can then also bring in is the income element of any premium received on the granting of what would be a short lease. That leaves us therefore with just a little bit of tidying up to do so far as this chapter is concerned by looking at some interest income. Now again, basically the issues here we have touched upon in terms of chapter 2, but there's just a wee bit more detail now coming in. In chapter 2, when we looked at interest income, we defined for tax purposes 3 different types of interest income. Now all of these 3 different types are savings income, but the 3 different types were, I wonder if you can remember them. Firstly, what we saw in detail in many of our calculations on examples in chapter 2, the treatment of either bank deposit interest or building society interest. Now both of those are taxable forms of interest income, but they were received in a very specific way. They were said to be received net of basic rate tax having been deducted at source, i.e. 20% tax, deducted at source by the paying bank or building society. So all we had to remember to do in an exam question, pick up the amounts received and then show on our income tax computation for either the bank deposit interest or building society interest, the figure of amount received in our tax year times 100 over 80. That gross figure would then be included in the income tax computation in both, of course, our savings income column and, naturally enough, the total income column. That gross figure would then be charged to tax at the relevant savings rates there of tax. That would be done in computing the tax liability, and we would then be able to deduct the tax credit on such interest from the tax liability in deriving tax payable or even indeed tax repayable. If the tax credit on the interest income were bigger than the tax liability, it would indeed generate a repayment of tax. So that was the type of interest that mostly, again pardon the dreadful pun once more, but that mostly interested us back in chapter 2. But we also saw that there were 2 other types of interest. The easy one, the types of interest that would be exempt from income tax. There would be no chargeability, and the main example of that was income from an ISA, as it is known, an individual savings account. Now, we need to know just a little bit more about them. The fact remains that any such interest on an ISA is exempt there. But individual savings accounts have been for many years the most common form of tax-efficient investment. Yeah, of course it's tax-efficient. Any income derived from an ISA, we've spoken here specifically in relation to interest income, but we could also have shares or stocks held within an individual savings account, and the interest or dividend income on shares, would also be exempted within this ISA. So income is free of income tax. Also, the disposal of an investment within an ISA, i.e. shares, most likely there, would be exempt, would be free from CGT. There is no minimum holding period here, and withdrawals can be made at any time. So very flexible, very tax efficient. The only problem at the moment, very low interest rates in relation to any deposits that you have within it. But again, hugely tax efficient, a most sensible vehicle for you to hold your bank deposits, or indeed to hold shares within, in order to free them from any income tax charges. What can go into an ISA? Well, you can hold cash, obviously within some sort of bank account or other financial institution, and as we've just mentioned, stocks and shares. Stocks and shares listed indeed anywhere in the world may be held within an ISA. All the income then that goes to them will be exempt from income tax, and in relation to stocks and shares, there'll be no chargeability to CGT as and when those stocks or shares are sold. There are limits, of course, that will now apply each year in terms of the amount of investment that is available to you. But these levels of investment have gone up significantly over the last few years. And now our annual subscription limit for our 15-16 tax year is £15,240. And what now happens, it was not always so, but ISAs permit the taxpayer complete flexibility over the mix of investments, as we've just read, in either cash or stocks and shares. Now that means that if you want to invest the full £15,240 in the 15-16 tax year, you could do so, and you could split that any which way you want between deposits that will earn interest and the holding of stocks or shares that will either earn interest or dividend income. Now that level of 15,240 will be provided in the tax rates and allowances section of the exam paper, and if you look it up there on your rates and allowances page, you will know it to be there. So that is not a figure to be learnt. Again, there will be, as you discover when you go through the questions that have been set by the ACCA, or at least the few that they have released to us. And when you look in, as you should be using later, the exam or revision kit from one of the official ACCA official providers of such material that contain therefore past examination questions as they are allowed to reproduce, then you will discover that you will get objective testing questions. Obviously it's not going to test out that figure in isolation because that's a given figure, but what they often test out is, of course, now the ability to mix, to know that you are able to have any combination, any mix of the deposits that you wish in the tax year. So again, make sure you know it and you'll see it tested in that type of question. Finally here, national savings. Now, there are a variety of products which are tax-free, namely, again, this was mentioned back in Chapter 2, national savings certificates. If you see the word there, certificates, then the interest income derived therefrom, that is exempt. But we also have some types of national savings investments that are held in the form of, here's some examples, easy access account, direct saver account, or the national savings investment accounts. Now those forms of interest are taxable. But what differentiates them, I hope you remember from Chapter 2, is that the income that is received that is taxable is received gross, without therefore any tax credit, without any deduction of tax at source. So what you do not do here is go and gross that up. So you might be given a figure like National Savings and Investment Account interest credited in the year £800 or £80 or some other figure that is very easy to gross times 100 over 80. Don't. It is already a gross figure. Okay. Now what that means you should now be able to do is not just read again through the Finance Act 2015 technical article, this time as far as review the ACCA section, so not as far as I should say, but review the ACCA section, in addition to what you have reviewed after Chapter 2. That's technical article written by the F6 examining team, of course. And then plenty of work for you now to get on with. You can use at the back of this set of course notes practice questions 1 through to 9 there. A variety of questions of various lengths, some of them, of course, being representative of, say, an objective testing question. Other may be, well, an objective testing question set in Section A. Others, like the objective testing questions set in your cases in Section B, are otherwise part of a Section C question. So you should now get on with those, practice those, make sure that you're happy with those outcomes, and obviously post any queries you may have on the Ask the Tutor site. In our next session together, what we will be doing is to look, as we said in Chapter 4, at a hugely important area so far as your syllabus is concerned, and that is for the unincorporated trader. So we'll be dealing either with a sole trader or with a partnership, and picking up the statement of profit or loss, or profit and loss account as I've always called them over the years, picking up the statement of profit or loss and taking what is a bottom line accounting net profit and adjusting it to make it acceptable for taxation purposes. What we're going to have is a series of chapters that deal with the unincorporated trader. In Chapter 4, we'll see, as I've just said, how we take an accounting profit and adjust it to make it acceptable for taxation purposes. Now, the concept of an adjustment is very simple. We take the accounting profit and we either add back debits from the statement of profit or loss, deductions that have been made that are not now allowable for taxation, or we do deductions, we minus from that figure credits on the statement of profit or loss that in fact are not trading income and therefore should come out in deriving what is the trading income assessment. In Chapter 5, we'll see how we give tax relief for capital expenditure in the form of capital allowances, another hugely important chapter. And those two chapters are relevant not just here in income tax, but 90% of the rules that we learn there are also relevant in corporate tax. And you will be tested in your exam. You will absolutely be tested on adjustment of profits and on capital allowances. The only thing I can't tell you is whether they will be tested in the context of a company in corporate tax or in the context of an unincorporated trader in income tax. But they will be tested, and they can be tested across the board in any or all of the 3 sections of the paper, so they are fundamental chapters for us to get to grips with. And again, those skills, when we learn them, will be killing, if we, the old English proverb there. Again, we've got some nasty English proverbs, but killing 2 birds with 1 stone, as we say. Yes, indeed, the work that we do will be relevant both in income tax and also mostly in terms of corporate tax as well. So we look forward to dealing with you, those issues with you in Chapter 4 and in Chapter 5. So join us again next time for the adjustment of profits so far as Chapter 4 is concerned.